And I think now we can move to the next session. The next session is going to be about markets outlook and equity valuation, and it is going to be chaired by Mrs. Teresa Farmaki. Teresa is the managing partner and co-founder of Astarte Capital Partners, which focuses on real assets. Teresa is a seasoned professional. She's also serving as a non-exec member of the Athens International Airport. She's a frequent speaker at the executive programs of London Business School, and she holds an MBA from Columbia and a BA from the University of Athens. Teresa, thank you very much for being with us today. And the floor and the speakers are yours now. Thank you.
Thank you very much. So welcome everyone from my side as well to the next session covering markets outlook and valuations. I have with me two exceptional professionals and speakers to share their thoughts on the subject, Dr. Lawrence Swinkels and David Jessop. Before I turn to them, introducing them and letting them share their thoughts, just for housekeeping, as you know probably already, just feel free to share your questions and we will allow enough time at the end to go through them. So without further ado, Dr. Lawrence Swinkels is an executive director and head of solutions research at Robeco and an associate professor of finance at Erasmus University in Rotterdam. His areas of expertise cover allocation research and empirical asset pricing. He is from Netherlands and he lives in Norway. And David Jessop, he was head of investment research at Columbia Threadneedle, and prior to that, he was at UBS on the sales side for more than 15 years as global head of quantitative research. He's also worked for Citigroup and for Morgan Grenfell. So without further ado, please, starting maybe from Dr. Swinkels, over to you for your presentation.
Okay, thank you. Just checking whether the sharing works. Can you see my screen?
Yes, we can. Perfect.
Okay, thanks a lot for the invitation to speak on our 5-year markets outlook, which is called the Still Renaissance. So maybe first a few words about the company that I work for. So the company name is Robeco. We are the investment engineers, and the first two letters of the company name stands for Rotterdam. So that's where our headquarters is in the Netherlands. So it's basically the Rotterdam Investment Consortium. And our key strength is that all our investments are research driven. And that's why we also like to call ourselves investment engineers. And at the bottom of the slide, you can see that we have about 260 billion euros in assets. And I have about 1,000 colleagues spread around over 13 countries in the world. Okay, so the 5-year expected returns is something that we publish every year in the end of the fall. And this year or last year is the 15th time we did this. And here you see the covers of each of the previous 5-year outlooks with the different themes that we have identified. This year it's called the Still Renaissance. On the one hand, very optimistic view, a renaissance, a rebirth of economic growth driven by artificial intelligence and the extra computing power that we have. But on the other hand, also a little bit still. And the still is because of the divided economic policies that we see over the world that are not optimal for the highest economic growth across the globe. So a little bit of a contradiction. On the one hand, a positive note, renaissance. On the other hand, it's a little bit still. So what I will first do is say a little bit about the how we approach our 5-year expected returns. And then in the second part of the presentation, I will say something about actually how we view valuations in a macro context. So first, our approach. So we have a steady state, a long-term expected returns report, capital markets assumptions report. That's a separate report and that we update every 5 years. And every year, we look actually at what is the valuation of each asset class? Which asset classes are expensive? Which asset classes are cheap? Because they can affect the expected returns for the near future. But at the same time, we also know that sometimes assets are expensive or cheap for a good reason. For example, there can be a lot of macroeconomic growth, or there can be not so much economic growth. So to put these valuations into perspective, we also have macroeconomic scenario analysis, where we say something about our projections where economy will be for the next 5 years. Today, I will only talk about the base case, but we also discuss a bull and a bear case scenario in the report. Since the last 5 years, we also have an element in it that relates to climate change. So how does climate change risk affect asset prices? And we also analyze that not at the individual company level, or issuer level, you can say, but we assess all of this at an asset class level. And if we add these numbers together, so on the one hand, the long run steady state, and then valuation, macro and climate deviations from the steady state, then we get to our 5-year expected returns. So that's our methodology. And what I would like to do now is to go through the 3 main asset classes, being government bonds, corporate bonds, and equities, and talk a little bit about how we look at valuation and what that means in a macro context for expected returns. So first, for government bonds. So in the report, we have many different valuation indicators for each asset class, but I have only a few minutes to talk here. So I picked one of those valuation indicators that I think illustrates best the point I want to make about the asset class. So here on the right-hand side, you see real interest rates on government bonds for several countries. This is the 5-year real interest rate, and how it has moved over time. In our steady state report, we see that plus 1% real interest rate, that's what we expect in a normal steady state case to be like that. Since 2011, when we started doing this expected returns report, we've seen that for Germany, for US, UK, most of the time, the real interest rate has been negative. Actually, I had several people in the past claiming that it doesn't make sense to have a steady state of plus 1% because real interest rates will never be positive again. But this all changed in 2022 when real interest rates moved up very sharply within a year. And we see that Japan is a little bit exception, but for Germany, US, and UK, real interest rates are positive again. And for the US, they even have shot through the 1% and even were above 2% for a little while, although they have come down a little bit. So given that these real interest rates are now pretty close to 1%, we would say that government bonds have a fair valuation. They're close to long-run equilibrium levels. However, we expect that the nominal rates of the US, they will, in the next 5 years, will increase a little bit. And the main reasoning is the end of US exceptionalism. So the economic policies that we currently see from the US, they seem to be targeted to no longer have the US as a safe haven asset, which creates upward pressure for bond yields, long end bond yields, which is not so good for returns on bonds if the yields are increasing. For Germany, we see that yields may also increase modestly to slightly above 3%, but that there's downward pressure on German bond yields because some of the capital that may be fleeing from the US is searching for a safe haven, and then German treasuries may be the next best thing as a safe haven asset. Higher real yields and also nominal yields make life more difficult for corporates and to refinance their debt because now they have to pay higher coupons. So that will be coming back in my next slide when we evaluate corporate bonds. You cannot see really from here the emerging markets view that we have, but yields are higher there. And since we don't expect major problems in emerging markets, that actually is kind of the expected return that we see for an investor on emerging markets, local currency debt. Okay. Then I move on to corporate bonds, or like credit risk, I should say. So here on the right-hand side, you see credit spreads over more than 25-year periods. It's important here that this is from one single rating category, and I picked here single B as a rating category. When you look over longer periods of time on credit indices, you see that credit indices, they change in quality composition over time. So actually, investment grade index has become more risky over time. So more triple Bs in that index now than there were 20 years ago. High yield, on the other hand, has become more safe. So there's more double Bs in the index than there was 20 years ago. So if you don't take it into account and you just look at the credit spread of the index, you're comparing different credit qualities over time. So to avoid that, I'm just picking here single B as one example, but I could have also picked another rating class. And in the report, actually, we also have other rating classes. Here you see the spread of European corporates, US corporates, and also hard currency emerging market governments, dollar bonds issued by emerging markets. The spreads move pretty much in line with each other, indicating a global price of credit risk. And during recessions or preceding recessions, these spreads are typically shooting up. What we see at the end of the period here is that the red and the blue line are pretty low. So very tight spreads on the credit side, on the corporate credit side especially. Actually, on the hard currency emerging markets front, the spreads look a little bit better, with close to median levels of spreads over this whole period. But from this graph, since we expect a typical downgrade default cycle because of the higher real and nominal interest rates, we think there is only little compensation for default risk for the next 5 years. So investment grade corporates, we have a little bit higher return than sovereign bonds, but only 25 basis points. And for high yield, 25 basis points more. But this is below the long-term compensation that you can expect for credit risk. The valuation for emerging markets is a little bit better, and that's why we have a little bit higher expected return than for corporate bonds of the same rating class. Yeah. Okay, then I move on to my last slide on the asset class level, at least, which is covering equities. Here we have to be very careful in the sense that equity markets have been expensive, but they have been expensive for a while. So on the right-hand side, I use the implied equity risk premium, which is the earnings yield of forward earnings divided by price of different regions in the world, and then compare it to the bond yield of that region. And then you can see whether you get a higher yield on equity markets or on bond markets. So it's a relative valuation tool. So if we start with the red line, the US valuation, then until a couple of years ago, when also price earnings ratios of the US were pretty high and considered pretty expensive, the explanation at that time was they are high because interest rates are so low. But we just saw that interest rates shot up during 2022, but stock markets are still equally expensive. So maybe interest rates were not the only explanation for US markets to be very expensive. And interest rates going up, an expensive US stock market together, means that this implied premium, the difference in yield between equity markets and bond markets, has come down to virtually zero, implying a zero equity premium over bonds for investors in US equity markets.
And if I can kindly give a 1 minute notice.
Yeah,
that's okay.
Yeah. So for Europe, the blue line, we see that the line is much higher, so it hasn't come down as much. So there's a decent equity premium there. And for emerging markets, the equity premium is even larger than this. With emerging markets, you have to be a little bit careful because there's a huge dispersion in valuations. For example, India is very expensive, while China is very cheap. So country allocation within emerging markets may be very promising avenue to take. So then I come to my last slide, my closing slide. So navigating this still renaissance, you see on the right-hand side, depending whether you're a euro investor or dollar investor, our expected returns, nominal returns per year for each of the asset classes. Maybe the last comment, I think most other building blocks I talked about. Many people are worried about whether we're in a bubble right now, an equity bubble. So I think when I think back about the early 2000s, when we were in a IT bubble, the feeling of the market was that we're in a new world. Valuations don't matter. There was no worry at all in the market. So this irrational exuberance. Today, people are talking about risks all the time, about AI risks, but also about geopolitical risks, risks of recession. So I think this time, in that sense, is different. The market is expensive, but investors are climbing a wall of worry and not convinced that they're in a golden age where risk doesn't matter. So that makes me a little bit less worried about that we are in a big bubble than I was in the early 2000s. Okay, thanks a lot.
Thank you very much, Dr. Swinkels. This has been very insightful and very interesting comments. David Jessop, over to you.
Thank you. Good afternoon, everybody. I'm just going to wait. There we go. Just need to share my slides. There we go. So thank you to everybody for inviting me along to this. My talk is more sort of theoretical. Well, it's not really theoretical, but it's sort of coming at valuation from a sort of slightly critical point of view. And what I was going to start with is this slide. This is something that we see quite often. This is a normal, valuation spreadsheet. I got this from Damodaran's sort of webpage at the Stern School. He's got some fantastic sort of things on his webpage, so do have a nosy there. And what you get, you have this lovely valuation model. It's got a sort of forecast, growth rate and payout ratio, dividends per share, everything else. We take the present value and we get a value per share right at the bottom here of 198.06, which is astoundingly accurate. And we're forecasting out here on this model. They're doing 10 years, and these numbers are just coming over as being, really quite amazingly detailed. And I, especially in my previous role when I was at Columbia Threadneedle, we had various sort of private equity infrastructure funds, and we went through this process every quarter, trying to come up with a value for all the different assets. And you have to do it. I'm not criticizing that, but I think there is a problem here, and it's a problem here that we really often don't talk about, which is we're assuming that all the inputs are known with certainty, and that obviously can't be true. And so I just sort of want to illustrate that over the next, say, 10 minutes or so, but doing it really with a very, very sort of simple model. And there's nothing special about the way I've done this. I could have done this with a much more complex setup, and I'd get exactly the same results. So, we all know the classic dividend discount model, which is what, effectively what I've just shown you. We're saying the company value, or any asset, to be honest, is just the sum of its expected future cash flows. If you want to put it in a bond term, it's a cash flow sort of story. And when we discount that by some discount rate K, we add them all up over the next sort of whatever periods that may be, maybe infinite, maybe not, and we get a value of the company, a theoretical value. What I'm going to work with here is simply the Gordon growth model. Why? Because there are only really 3 or 4 parameters that we have to worry about, and it illustrates the point. So let me just sort of give you the starting point here. I took the current US 10-year yield as my risk-free rate, just over 4%. I've got a security with a beta of 1.23. I said my equity risk premium is 5%. And so my cost of equity, sort of putting all that together, is 10.3. My initial dividend was 6.3, which was chosen very, very carefully, so that when I had a dividend growth of 4%, I got an answer of 100. There is nothing, again, don't take this anything special about this. This is just sort of say it's illustrative. You might not want to do this as valuation. You could think of this as in a sort of a listed equity world as basically, what's the sort of the value we're putting on it compared to today's share price. And instead of getting a valuation out, really what you're getting out is a percentage upside or a percentage of misvaluation. And so putting that into a picture, here we have top left, the equity risk premium, which is 5%. We've got the beta, top right. We have the growth rate of the dividends, bottom left, 4%. And we have the value, which was 100. So that's all well and good. But as I say, we're assuming we know all these parameters really well. So I went off to a wonderful series of papers. This is by sort of Fernandez et al. And every year he does a survey of academics and practitioners about risk premia and risk-free rates and a few other bits and pieces, but that's the sort of the main point. And this was for 2025 paper. What's the equity risk premium? That's on the y-axis, and the risk-free rate, which I do find some of the results for both of these axes slightly weird, on the left-hand axis. So if we ignore criticizing him for starting a chart where the y-axis doesn't start at 0, but we'll skip that. What can we see? Well, we've got a blob here in the middle. And yeah, the equity risk premium, the market risk premium, as he calls it, it's sort of between 4 and 6, 4 and 7, sort of, but it's not 5. Whoever answered close to above 15%, I quite wonder what on earth they were thinking. So there are some very bizarre answers in here. I think people sometimes maybe take this question as what's your forecast for the next 12 months for the returns? I don't know. Because no way is the equity risk premium for the US, well, any market, 15%. But it's not one number, it's a distribution. And that's really the point I was sort of trying to get at here. And let's do the same thing. So here I'm now going to use UK data because I could get a better history of that. And, for the FTSE, the total return, if I go from 1994, so that's 30 years, just over, it has a risk premium of 4.5. So again, 4.5, 5, not bad numbers, but this is a mean. It's an estimate of the mean of a distribution of a time series, and the standard error of that is about 2.7%. So although we've got a mean of 4.5, we really don't know it very well. If I assume the same sort of distribution, and I say, okay, let's get the whole 100-year history. I couldn't get hold of that, but I know you can go back about 100 years. You can do the same for the S&P. I've done that in the past. You get about 5% again, roughly. But even then, even if you have 100 years of data, and this is one of the classic problems of finance is, you can't, sampling or anything else makes no difference to the standard error of your mean. Your standard error is about 1.5%. So let's take that 1.5% standard error. Let's, in a sort of a Bayesian type way, let's pop it into our valuation model and let's see what it does. So top left again is my equity risk premium. I'm assuming I know the beta and the growth. And all of a sudden my value varies between about 50, maybe a little higher than 50. And actually the maximum there, I cut the chart at 300. It actually goes up to 355 is the biggest value I get, with obviously some really extreme value of the risk premium, very low, obviously. So actually, when we say the value is 100, well, actually, no. I mean, the interquartile range here was about 27, a value between 27. So, it's obviously skewed, but it's not very accurate. Okay. Let's keep going. You can sort of see now where for the next 2 minutes I'm about to go. What about the beta? So I'm slightly old-fashioned. I much prefer R over Python. Everywhere you look, people want Python. I think R is infinitely better, but never mind. So this is my estimate of the beta I did. This is 3 years of weekly data. It was, I can't even remember which stock I used. I just used a random but fairly well-behaved stock. And I get a beta of 1.23 and an error of 0.17. in that estimate. So once again, I don't know the beta very, I know the beta is bigger than 1, almost certainly. But, beyond that, I can't really say a lot, within that range. Again, ask this, sort of do the same thing. Let's now sample both the equity risk premium and the beta, and we get a very similar picture. Now, this is the point where actually these pictures become quite hard to interpret. The maximum value now is 450. And the interquartile range has gone up from about 27 to 32. So what happens is a lot of things sort of stay in the middle, but the whole sort of distribution just edges wider as we do this. And actually what's important here is those two effects, and particularly the equity risk premium effect, really are the biggest. I don't have time to go into a lot of the sort of other numbers I've done around this, but what you find is and I'll sort of come back to this point, it's very much these things on the bottom line of the valuation model that will really make a massive difference. Finally, what about the growth rate? Well, here I've used 4. This was a bit of a guess. I'm probably being very generous here to my ability of forecasting long-term growth. So, where I got the 0.5 from, by the way, is I looked at the very long-term growth of the UK economy. On average, it's about 2% nominal, obviously, but dividends are nominal. And that had a standard error of about 0.25. So I thought, okay, I've doubled my growth rate, so let's assume double the standard error. Is that right? I have no idea, but as I say, this is really illustrating the point. And what we can see here is, for some reason, my graphics package decided to put a very thin white line in the middle of the growth chart, purely an artifact. And once again, the value gets wider, the interquartile range has gone up again. And actually, the maximum I got out of this one, on the particular run I did here, was 1,783. So that, okay, very unlikely. I don't think we'd accept it, but that's in there. So these things, these valuation models are not very accurate at forecasting, and this is where I'm going to come on to, at forecasting absolute returns. And as I say here, much of this comes to the bottom line. So what can we do about this? And we saw this in the previous talk. We're not looking at absolute valuations. You start looking at relative valuations. And the trick, if you excuse the phrase here, is to try and compare assets. I've called them companies. I probably should have said assets, where you can sort of say the bottom lines are similar. Obviously, the equity risk premium is the same no matter which asset you're looking at least in the same market. But if if you say got 2 companies in the same sector, you can probably assume similar betas. And yes, there might be a little error there, but it's a lot smaller. And so what I did here was I said, and again, I didn't have the time to really go into this, I've got 2 companies. I've said, okay, let's assume dividends are driven by economic growth, nothing else. They're really simple, boring, straightforward companies. One pays a very big dividend but grows slowly. One pays a smaller dividend but grows quicker. So I set them up again in the background so they have the same value. Obviously, maybe you'd look here at return forecasting rather than the actual valuation, but that's okay. And what we get here is this picture. So this is the fast grower price minus the slow grower price. Now, there isn't a big difference here. And I probably, in terms of doing this picture, I should have probably pushed this distribution a bit wider, but it doesn't matter. I mean, it makes the point. So here I can sort of say 76% of the time, the fast grower company is actually worth more than the slow growing company. And something like that, looking at this as saying very much in a sort of a Bayesian framework, for me, it has to be the direction to go. But it does, as say, it means absolute valuations are really very inaccurate. And it's very, very difficult to come up with, you can't justify a single number. It's going to be wrong. And so thinking of these things as distributions and at least being aware of that and maybe being open about that could be a good idea. So just finishing again, as I say, to summarize very quickly what I've just talked about, the errors in these valuation models are often, they're ignored. We've all seen, as I say, go back to my first slide, people who are analysts, whether they're listed assets, whether it's unlisted assets, using these valuation models. And yeah, they look a little bit at what they call sensitivity analysis, but really it's, you don't know these numbers accurately. And your sensitivity analysis really is saying, actually, your forecast is wrong, or should be be careful my English there, sorry. it should be a distribution, not a single point. And as I say, I really find it very hard to think for an absolute valuation model how you get around this, because the equity risk premium, we just don't know it. As I say, even if you go with 100 years of data, which is pretty much the most you can do in most cases, your standard error and your estimates are around 1 to 1.5%, and that's been true in various data sets I've looked at over the time. So with that, I've taken up my 15 minutes pretty closely.
Thank you.
Which will keep Teresa very happy. And that's always very important. And so with that, I will pause and stop sharing my screen and pass back to Teresa.
Thank you very much, David. Very interesting, a different perspective into the subject, and very well played points, I have to say. So maybe as a first question to Lawrence. Lawrence, you touched on emerging markets, but what about emerging markets debt as an asset class? Maybe very brief thoughts on that, as we have a quite interesting also sequence of questions coming up. So.
Yes, of course. So I think for emerging markets debt, it's really important whether you consider this the local currency market, which is actually grown a lot and is now much bigger than the hard currency market. There's two important drivers. That's the interest rate in the countries that we're looking at, but also much more important for a more short-run investor is what these emerging markets currencies are going to do versus your base currency, so euro or dollar. So over the past 10 years, maybe with the exception of last year, we've seen that the dollar became very strong and that emerging debt actually performed pretty poorly. That has changed a little bit since last year with the tariff announcements by Trump. The dollar has weakened a little bit. We expect it to weaken a little bit further, but to keep that in check. So not a negative for emerging markets debt. And since the yields are around 6%, we are quite positive that emerging markets debt on the local currency basis can outperform government debt from developed markets over the next 5 years. For hard currency, that market consists of more than 70 different countries. Like I said in the presentation, the spreads are typically a little bit more favorable given the rating than for corporate debt. But it is ultimately an asset class that is priced off US Treasuries. So it's like US Treasuries plus or minus a spread. And that can behave very differently from local currency debt. So investors should be aware of it. That is the case. And I'd like to see it to position it relative to corporate debt. And then I think it's a little bit more attractive at this moment.
Perfect. Thank you. And David, an interesting question for you, because I think it touches also on some of your last slides, which maybe I had to rush you, and I hope I didn't have to rush you, but as an additional opportunity. So given the uncertainty, I guess, in the estimation, right, of expected returns, how much faith should we have in the market's outlook? And how can this become more credible? What should these investors disclose if we can do?
I think a lot of it is, I take Lauren's last reply. By the way, I have never seen Rotterdam looking quite as snowy as his obviously the view out of the window behind him. What is the comment he made there is emerging market debt is sort of dollar emerging market debt is basically emerging market, sort of that market minus US Treasuries. It's a relative forecast, and so that's really where the thing you very few of us just go into cash. You tend to start with some sort of benchmark, with some sort of starting point, which subsumes that equity risk premium error. So if my benchmark is 100% US debt, let's say, all of a sudden any sort of risk premium estimate, that's gone, because that's in my benchmark. I don't care what the absolute return of the benchmark is, because that's what I'm being measured against. So in a sense, it's that relative performance becomes, or that relative valuation, where that error is still there. I mean, obviously there is a risk premium of emerging market over US debt or whatever other asset classes you want to talk about. But the errors start to become smaller. You probably know more about the risk premium in some ways because it's positive. Well, it's fine, and you can make reasonable assumptions about it. So it's really this point about you look at relative valuations and you try and subsume that idea of get rid of this estimate of the absolute equity risk or fixed income risk premium, because as I say, you just don't know it.
Thank you. Next question is for Lawrence, but it would be interesting, I think, to hear from both sides, actually, from both speakers. So do you share the optimism of investors for 2026? They seem to disregard geopolitical risks and the AI bubble. What is your view on this, and how do your models predict for 2026? So starting with Lawrence, and
Yeah, of course, this is
David,
the
happy to hear
glass
from you as well.
the glass ball. By the way,
Yeah.
this is Oslo in the background. I live in Oslo, so that's why it's so snowy. This is, of course, the glass ball question, the crystal ball question to know what the markets are doing. I'm not so worried that there will be big collapse of the AI bubble, but maybe it's not a bubble. Maybe it's a rational bubble. I don't know how to say it. In the sense that at least what is really different compared to the IT bubble that we saw before is that at that time companies were promising to get revenues in the future. Today's expensive companies, they have very strong revenues. They are market dominant in their markets. They're almost monopolists in that's the field they're operating in, and they're way ahead of in a R&D sense of competitors often. So I think in that sense there is some rationality to it. It is not just air that is being sold; it's actual profits. Will the profits be as high as is currently priced in? For us, that is really we have a bull and a bear case scenario, I said. So the markets are priced as if it's in our bull case scenario, where there's a lot of growth coming from AI, and that's why we expect a little bit less of US equities, but not an imminent crash as some people are worried about.
Yeah. David, any additional thoughts from you?
You always have to remember to go off mute. I mean, I think it's interesting. I think Lauren's point there, I mean, thinking back to the tech bubble of 2000, he's right. Most of these companies, I mean, people were coming up with the most fantastical ways of valuing companies, price per click or price per something else, because they couldn't use everybody's traditional, price earnings ratio.
Yeah.
I also remember, actually, I was at what was Solomon Brothers at the time, or Citigroup now. We actually wrote a piece called "The Last Value Investor in the Room, Please Turn Off the Lights," and talking about how people were actually using momentum as a value measure because all the value investors couldn't make money, and so and it was sort of fiction in a way, and I agree with Lawrence. At least ChatGPT and all the underlying companies, I should say, they are making money. Are they overvalued? Or are the future, forecasts particularly optimistic? Well, probably, but they always are in these situations. But I think that's a different point. I think it's right. At least these companies have some sort of economic foundation. I think my worry with some of them, if I had one, is the sort of cross ownership, how, NVIDIA funds OpenAI, or whatever the company's called, OpenAI, to sort of effectively it funds it to buy its own chips. There seems to be some interesting, slightly untransparent financial engineering, let's call it, going along there, which is, yeah, I think that would, if there is something that would worry me, it would probably be that.
Okay, thank you. So maybe switching in the last couple of minutes we have in a slightly different subject, which is ESG. And Robeco is doing a lot in ESG. Most companies are doing, or a lot of companies are doing a lot in ESG. So, however, the question is whether the evidence recently shows that ESG pays or not. And what are your thoughts on that? Would you suggest that pension funds sacrifice return for ESG criteria?
I think my take on this is there's two parts to it. Does ESG make money? I mean, ESG, we've got to be very careful here because you're combining three very, very different things. Environmental concerns, are very different from governance concerns. We've known about governance. My whole investing career, you don't invest in badly governed companies. Companies where the management don't know what they're doing or whatever do badly, full stop. That's pretty true over many years. That's the quality. You can think of that as the quality effect. So I think I don't think there's any doubt about that. I think the other two topics are interesting. I think there's the picture from an individual analyst's point of view, and there's the picture from a portfolio manager's point of view. And for an individual analyst, if you've covered the auto industry over the past 10, 20 years, the whole of this thing is relevant. Tesla's come up, electric cars, all of that area. So as an individual analyst, I don't think it's necessarily a money-making question. It's just a completely relevant thing for being an analyst and for understanding what drives
And
companies.
if I may stop you there, just to allow Lawrence as well, given the reference to Robeco, a very quick comment as well. And I think we need to wrap it up because we are
Okay, sorry.
right on time. But thank you very
No,
much, and
that's okay.
apologies for interrupting.
So I think, but I agree a lot with what David had to say about this topic. So I think integrating aspects of E, S, and G in the investment process, it can only be good because there's information in there, and you can judge whether that is value relevant and then make a good investment decision on it. Where it becomes a little bit more tricky is when you are going to blindly exclude companies and just regardless of the price are going to say, I'm not want to be associated with them. That can be, it doesn't have to be, but it can be costly because at some points, these companies that nobody wants to invest in, they may be very attractive from a financial economic point of view. So that's why I prefer to have more integration and a dialogue with the company than to blindly exclude. But I understand that some people don't want to be associated with some very bad companies also. So but maybe that has a price tag to not be associated with those.
Thank you very much. And again, apologies for any interruption. I think we could have a much longer discussion, which I would love to have. But thank you very much for your thoughts. And we're back to George and the event for the next
Thank you,
session.
Teresa. Thanks.
Thank you, Teresa, and thank you, Lawrence and David. This has been a very stimulating panel once again, and actually ties very nicely with topics which have been discussed previously and topics which are going to be discussed in the remaining of the conference.